Thank you very much and welcome, ladies and gentlemen, to our panel on a case study in failed integration financial services. It's a pleasure to moderate this distinguished panel in the order in which they'll speak, which is from left to my right here. Our panelists are Paulo Salgado, Assistant Professor of Law at George Mason University, Neve Maloney, Professor of Law at the London School of Economics, David Zering, Professor of Legal Studies and Business Ethics at the Wharton School, and Catherine Judge, Professor of Law at the Columbia Law School. Our discussion will take up, as described by the organizers, the complex mixes, arguably messes, of erratic financial integration in the US and the EU. This description makes me think of my friend and the great banking scholar Charlie Calamiris, who describes every banking system as a mutually advantageous deal between bankers and politicians. A mutually advantageous deal between bankers and politicians. Given that that's the essence of what we're doing, it follows that complex, mixed, or messy outcomes are to be expected when these deals are made across federations or federal unions of component states. Now, here are three questions I suggest about these deals in political finance. First, banking is very helpful in financing the state. It's essential to all these deals. But which part of the federated combination of states is to get the most benefit from this financing? Second, banking is in its essence risky, and as we know, very costly to states that back bank solvency. Who exactly gets to eat the cost when things periodically collapse? And third, which level of politicians within the federated combination is dominant in making the deals with the bankers? Given these political factors, it seems that financial integration will always be historically contingent and path-dependent, not based on some ideal of rationalization, and therefore messy. Let me just mention three cases of financial integration from American financial history, which have current EU analogies. One, I suggest the chartering of U.S. national banks, the chartering of banks by the central government, and compare this to proposals for having European bank charters. Second, the centralization of the Federal Reserve System as we consider the possible future evolution of the ECB and its component central banks. Third, the national concentration of U.S. housing finance, a gigantic market, in Fannie Mae and Freddie Mac. Think of new proposals for an EU-wide Fannie Mae analogy to securitize mortgages with state guarantees. Briefly on the historical contingency of each of these examples, that the U.S. central government got into the business of chartering national banks reflected the government's need to sell a lot more treasury bonds to finance the Union armies in the Civil War. That's what it really was about. That the Federal Reserve was changed from a system of semi-independent regional reserve banks to a consolidated, centralized central bank, reflected the stresses of the Great Depression and how to cope with it. Third, that Fannie Mae and Freddie Mac seized the national mortgage market and became dominant, reflected the collapse of the old savings and loans. 2 decades later, of course, Fannie and Freddie themselves collapsed and were bailed out, and this, I have to put this line in, has converted them from so-called GSEs, that is government-sponsored enterprises, to what I call GOGSEs, that is government-owned and government-controlled entities, which is what they are now, and that is even more centralization. Well, that's it for my introductory musings. Our panelists will provide expert legal insight into the mixed and messy issues of financial integration in a federal structure. They'll each give opening remarks of about 10 minutes, then the panelists in the same order will have a chance to react to each other or clarify points, and then we'll move to more general discussion, including your questions, and the session will conclude at its revised ending time of 11:50. And with that, Paula, you have the floor.
Thank you, Alex. Thanks, Mike and Kirk, for bringing us all together. And it's fantastic to share the stage with three wonderful friends and colleagues. And I think I'm going to take everybody on a slightly, on a detour. I'm not going to talk about banks directly. I think as an Italian, European, and American, I like to talk a bit more about transatlantic dialogue in an area that is very nerdy, but also very dear to me, which is the world of derivatives market, where over the past 12 years, even 20 years, we have seen a lot of interesting development. So what I would like to do in my 10 minutes is to do primarily two things. First, I'd like to set a bit the stage for discussion on possible alternative mechanisms to address cross-border finance and to support the free flow of capital across the Atlantic, which is like something I'm very interested in. And then in the second half, or the second third, I'd like to talk about a story of integration, then turn into a story of potential disintegration of cross-border financial services. So the story I'm telling is a story of the derivatives market in the past 20 years, and in particular, the story of the post-Brexit EU and US-EU derivatives market. And I'm quite confident, maybe somebody in the back, but everybody is familiar with what happened in 2008. Maybe Gwendolyn, you're very young, but like in 2008 was a major financial crisis that was followed by major reforms. And also, I think that everybody's familiar with the Chicago Mercantile Exchange, the Intercontinental Exchange, Deutsche Börse, or the London Stock Exchange. Those are the wonderful players that for the past 20 years, they set the dialogue and the tone of the dialogue for cross-border integration and disintegration of financial market. So this financial market infrastructure group, the Chicago Mercantile Exchange, Deutsche Börse, they offer trading and post-trading services for financial instrument. And they've seen their role as cross-border provider of core financial services becoming more and more important after the financial crisis, when policymakers saw in this institution the solution to market instability, and so picked them as the true winners and the true stability enhancer and efficiency enhancer in the system. But since then, they've become extremely active and powerful in the global finance discourse. For my German friends, Deutsche Börse tried once to acquire and merge with the New York Stock Exchange, and the Commission said no. In 2017, they tried to merge with the London Stock Exchange, and the Commission said no again. It's kind of interesting. Perhaps now the Commission might be in a different position. They might reconsider their decision of blocking those mergers, particularly what probably Niamh is going to say about the Capital Markets Union, because what we are missing now in Europe is a big champion that can provide stable infrastructural services. And another reason why I'm really interested in this firm is because they've been at the center of the global policy discourse since the 1990s, so very long time ago. They have been one of the top priority for the financial diplomacy starting 2008. It was an important fact, for example, that in 2017, the vice chair for financial supervision, Randy Quarles, was also the chair of the Financial Stability Board, and then it was a very important statement in setting a tone for the importance of cross-border coordination in financial market. So I would like now to think a bit about different solutions, different ways, different approaches to deal with cross-border phenomenon. And perhaps I might be a bit oversimplistic, but I can see three different ways that can, a spectrum of three different ways that can be embraced to support regulatory and supervisory coordination or deal with cross-border risk. So on one extreme of the spectrum is what policymakers generally refer to as location policy. What does it mean? When policymakers lack incentive to coordinate, or they do not trust their fellow peer regulators, or they intend to protect their national market interest, they might just require foreign firms, if they want to provide their services in their jurisdiction, to incorporate and register with the jurisdiction. This is what's sometimes referred to as onshoring mechanism. That's happening right now in the EU-UK relationship, or what's happening here every now and then here in the US about the idea of domesticating foreign banks, or requiring foreign banks to become fully charter US institution to have a stronger grip on the risk they might bring to the system. Another way to sort of protect the domestic integrity is the approach that was embraced immediately after the financial crisis, what is generally referred to as extraterritorial financial regulation. And by using choice of law provision, domestic regulation sort of have a grip on foreign firms. So firms that deal with, let's say, US market participant, they have to register or be subject to the supervision and regulation of the US. On the other extreme of this domestication or location policy is the harmonized approach through international treaties, where harmonization is reached through binding rules that apply to signatories' jurisdiction, and that's the EU project. And two of the most recent example of this project of further harmonization are the banking union and capital markets union. And I think Niamh is the expert in the field. And if you want to learn more about European securities and financial market regulation, I strongly encourage you all to read Niamh's book on EU's financial regulation. And in between these two regimes is a hybrid approach. And hybrid approach that it's built on cooperation and deference. And this is the approach I'm particularly interested in, because I think has the potential of becoming the default approach to cross-border finance, or open border finance, as I recently said in a paper. And this cooperative approach is based on and built on trust, mutual recognition of equivalent regulatory and supervisory regime, and in some way deference when deemed appropriate to foreign regulators and supervisors. So this system of soft integration was embraced by the G20, now G19, after Russia was kicked out, which is like the largest 19 global economies, in a summit in St. Petersburg in 2013, where the G20 finance ministers said that jurisdiction and regulators should be able to defer to each other when it's justified by the quality of their respective regulatory and enforcement regime, based on similar outcome in a non-discriminatory way, paying due respect to home country regulation regime. So I think what is very important of this approach is the fact that two jurisdictions that share similar regulatory and supervisory principle and regime, that can allow foreign firms to offer their services by simply complying with their home regulation, rather than imposing additional compliance with the host country regulation. Making it a bit more concrete, in the EU and in the US, the European Commission and the European Securities Market Authority on the European side, and the Commodity Futures Trading Commission and the Security Exchange Commission on the US side, they engage in this comparative work that I think, as an academic, are very interesting processes to deem if their regulatory regime can be deemed comparable and equivalent. And if the result of this determination is positive, US and EU firms can offer their services across the pond without having to comply with the host jurisdiction. So I think this equivalence determination, as we saw in the post-Brexit scenario, are extremely important because they give access to foreign markets, but at the same time, they're demanding and highly politically charged. The EU-UK post-Brexit equivalence negotiation was the truly iconic situation where the negotiation and the strong refusal of the EU to grant equivalence was purely political. the UK and the EU had the same regulatory framework and supervisory approaches to financial market infrastructure. And it was just a political decision of the EU to punish, I think, in my personal view, the UK from their decision of exiting the EU. In this equivalence framework, I think an important role is also played by international standard setters. International standard setters, and perhaps David might talk a bit more about this because he wrote a great book, The Globalized Governance of Finance, that are institutions like the Financial Stability Board, the International Organization of Securities Commissions, and the Committee for Payment and Market Infrastructure. What this international organization do is to draft principle and guidelines that can inform and support domestic lawmakers and regulators in their approach to regulating and supervising financial institutions. The important aspect, I think, in my opinion, that these international standard setters have been playing is, on one side, they provide a forum for domestic regulators from around the globe and the industry to engage in an open debate on the most appropriate approach on our regulated market. And at the same time, they've been providing a very useful tool to support open access to markets in the EU and in the UK and the US. Why I'm saying that is because, for example, when in 2016, the Commodity Futures Trading Commission under Chair Giancarlo started strong negotiation with the EU and the UK for equivalence determination, the principles that were set and adopted internationally really guided the debate and were used as sort of the backbone of all negotiations. So it was a very good starting point for peer jurisdiction to start and build an integrated and cooperative framework for the regulation and supervision of financial market. I think I have a minute and a half, so I just want to very briefly say one quick thing about how this equivalence played and why the political approaches on integration and disintegration played in the EU and UK scenario. The EU and the UK, the UK was until 2021 a member of the EU. Before that, UK firm, EU firm were able to access the London Stock Exchange, which is one of the largest global player as derivative trading and post-trading infrastructure on the base of passporting. The European Central Bank, starting from 2011, started to become concerned on many possible grounds on the fact that a big number, one of the largest volume of euro-denominated derivatives was cleared, was processed outside the Eurozone. And that was a big concern for the European Central Bank. We can discuss whether or not that was a true systemic risk concern or was more a ECB protectionist view, or try to give more market share to the European player. But the ECB tried to force this euro-denominated derivatives to relocate in the continent. The UK successfully challenged the European Court of Justice, the decision of the ECB. So that in some way, European players, European banks and financial institutions were able to access London through the base of passporting. Immediately after Brexit, in some way, the Commission got his revenge.
Time to wrap up.
Yeah, got his revenge.
Oh, thank you.
Yeah, got his revenge. And this revenge was try to reinforce and rebuild a location policy for derivatives. So where we are right now is that a successful story of financial integration, where London played as a critical financial center for the EU, became a story of disintegration immediately after Brexit, and the importance and the fact that the EU used the equivalence tool as a political tool to force the UK to come to concession and eventually to support Eurozone champions. To conclude, as stressed in multiple occasions by Chair Quarles, financial, cross-border international cooperation is necessary to support a stable global economy and to build a resilient financial system. And the U.S. participation in international financial organization is critical and to support the dialogue and to support the sort of free market view and capital flows that the US has been championed in the globe. And I think the equivalence process that have been used a lot in derivatives, but also in organic product by the USDA and the EU, can be a very balanced tool to, on one side, respect national sovereignty, and on the other side, support coordination and dialogue among markets. Thank you, Alex.
Thank you, Paulo. Niamh.
Thanks so much, Alex. Thanks, Chair. And first of all, it's just been a huge pleasure to be here. So can I really thank Michael, Craig, and also Donald from the Law and Economics Centre. It's just been an amazing day and a half, and I feel so privileged and honoured to have participated in these discussions. So thank you so much. So I'm going to speak a little bit about the role of law kind of not really succeeding in integrating capital markets in the EU. And I'm going to make 4 points. I'll start off by, if you'll forgive me, a really quick tour around what the context is here. So I'll do this super fast, and then I'll go on to sort of say, has it worked or not? So the EU single market, and this point was made yesterday indeed, is a sort of a massive, live, real-time experiment in the persistence of using law to integrate financial markets. So I think as many people in the room know, the free movement of financial services, of capital around the single market is based on mutual recognition, or very broadly, once a financial firm is authorised in one member state, that's the home state, it can then access all of the 26, the host states, under that authorisation, which we're used to, but is kind of extraordinary when you think about it, given how complex financial services are and how heavily regulated it is. Now, this is the passport mechanism, and it's unique internationally, given the multilateral scale on which it operates across the 27. Now, on the one hand, it's deceptively simple, but to very much go back to Daniel and to Jan yesterday, the reason this works is it is the EU as a law state. So the reason the host state gives up control, in effect, taking in the financial services based on the home state's regulation, is because of the single rule book. A huge construction of law, legislation, administrative law, soft law, which governs financial markets in the EU. And just to note, it's not convergence, it's not harmonization, this is hardcore regulation by the European institutions. Has it all supervised? Well, the standard arrangement is the home state, where the firm is anchored, does the supervision, and it also covers the pan-European activities of that firm. We have 3 agencies, 3 authorities that kind of coordinate all of this using soft law powers. Some of them have very, very specific and idiosyncratic direct supervisory powers, but it's rare because that is the third rail of political engagement in European financial services. Who gets to supervise what? Banking is the exception, because the big legacy from the financial crisis is that the European Central Bank does supervise banks in the euro area, but that is really very different. Now, what's the rationale for all of this on the capital market side? It's 2. One is single market construction. Remove the regulatory frictions, thereby allowing the services to move around the single market, single rule book, mutual recognition. But the other one, which is the one I want to talk about a bit more, is way more muscular and way more transformative. And that's to build, through law, capital markets, to build market finance in the EU, and to lessen the reliance on bank funding. Because the European economy is very, very heavily based on banks and bank loans. It lags significantly behind the US in terms of reliance on market finance. And all this right now is being pushed through the Capital Markets Union agenda. So Capital Markets Union is a sort of, I think, a chimera. I think it's not going to work. But it was adopted in 2015. It's a massive rule-based program, going back again to yesterday's discussions, to build securities markets in the EU through law. Has it worked? Okay, this huge regulatory project, really to do this muscular, let's build a market that looks like the US. Okay, first point is, it has in one respect, in that the EU is now pretty good at managing the risks of cross-border integration. So financial stability, investor protection, that all works pretty well on a cross-border pan-27 market. And that's not nothing. I mean, given the complexity of what we're dealing with, that is quite a big outcome. Super quick example, April 2020, markets in chaos. It's the COVID kind of collapse in bond markets globally. Investment funds are facing serious liquidity pressures. In the EU, they held up pretty well. And a lot of that can be associated with this granular rule book and pretty good supervisory coordination pipelines. So that's not so bad. But has it worked on the positive side? So driving integration and trying to build securities markets. This is way more contestable and way more doubtful. Now, we do know from these annual reports we get from the Commission on financial integration that capital markets have been integrating over time, so over the last sort of 25 years or so. So in other words, if you take your classic investment portfolio in any member state, there will be a lot of cross-border investments. Irish portfolio has German pension funds and it has, Nordic oil companies. You will see that across the portfolios in the EU. And the trend is sort of upwards in that regard. The other thing we're seeing is levels of integration are recovering more quickly after a shock. So classically in the EU, if there's some kind of economic or market shock, everybody pulls back to base. You start investing in your own companies, your own sovereign debt. That's now happening still, but the recovery is way faster. So in other words, we saw a bit of a shock with the Russian invasion of Ukraine, but portfolios did move back again cross-border pretty quickly after that happened. So that's not so bad, but fundamentally, capital markets have not grown in the EU. So, super quick data here. In 2007, the US represented 35% of global market capitalization, the EU 17%. By 2022, the US was up to 40%, the EU was down to 11%. Delistings from stock exchanges in the EU have been increasing since 2012. The average investment fund in the EU is 6 times smaller than the average fund in the US. The value of IPOs has been dropping since 2015. The scale of corporate bond issuance has been dropping over the last number of years. It's a really long story, but the thing to keep in mind is behind this is a massive rule book that's trying to construct the markets in capital. Similar story on the retail side. 10% of households in the EU have investment funds, 8% equity, 3% debt, 98% have deposits, 28% pensions. That has barely moved in 25 years, barely. And at the same time, the rule book is growing and expanding and getting kind of more ambitious. I mean, over that 25-year period, EU households are becoming more affluent, household financial assets are increasing. Since COVID, levels of savings have skyrocketed. There's 30 trillion euro sitting in EU deposit accounts for households right now. Okay, so some has worked, some really hasn't. Current context, it's all about completing capital markets union. So since autumn 2023, a really steady drumbeat, we have to get this done, we need private capital mobilized in the EU, and very unusually, the first time I've seen in 30 years, calls for agile regulation, simplification, burden lessening, lower transaction costs. On Thursday, the European Council, all the heads of government, meets 4 times a year, an urgent call to get this done. So there's a huge political push for this. Why? 2 reasons, really. One is a massive gap in investment funding. So the annual investment gap in the EU is €1 trillion that we're missing. So this has to be made up. On the asset side of the balance sheet, we have €33 trillion in household deposits. How are we going to get the two to meet? And the second concern related to this is about competitiveness. So annually, about €250 billion are moving to the US in investment in equities and bonds in US companies. That was more or less always the case. But in the last year or so, this has become a number you hear constantly in the political dialogue. Now, why? It's because of strategic autonomy. So since the COVID crisis, this real concern, we have to have our own vaccines, we have to have better supply lines, we need energy security, we also need funding security. So all of this is feeding into, we need stronger capital markets in the EU. So final point, where is this all going and what's the role of law in all of this? I think the first point is the single rule book, broadly seen as working in terms of things moving around in a steady state, if you like, across the EU and managing stability risks and investor protection risk. but not working in terms of deepening and driving the strength and competitiveness of the market. Now, on the positive side, I would say the whole project is becoming more sophisticated with a recognition of the limits of law. Law can only get you so far. So one of the big projects right now is a consolidated tape, which the US has had for years and years and years. So in other words, sort of a real-time pipeline of equity and bond data going all around all Europe's stock markets. We don't have that right now. So building that for around 2025, 26, that could be relevant. There's an increasing acceptance that specialization and not integration could be the way forward here. And here, going to Professor Galston's point yesterday, a slightly different vision of the federal project. Let's specialize in funds in Luxembourg. Let Ireland be really good at investment firms. Let the Nordic countries be really good at equity stock exchanges. That's beginning to come through, specialization of centres in the EU. Thirdly, taxation. Moving away from law into the taxation lever. How do we use tax capacity to strengthen capital markets in the EU? Fourthly, definitely a commitment to more targeted, more proportionate, more agile regulation. So I think those 4 points are kind of useful and they're positive. And my final remark is there's significant risks here because inevitably, I'm going to Daniel and Jan and I think Gareth as well yesterday, the EU has a powerful instinct to regulate where there's a problem. So what is the single biggest innovative, imaginative thing associated with Capital Markets Union? You won't be surprised, I suspect, to hear it's to build a whopping single regulator on the likes of the SEC for the entire 27 member state. Now, this is a massive political project. It's been hugely pushed by France. This is France's grand projet. They've been at this for the last 6 months. They're very, very good at how they do this. It's creating big political rifts between France and the smaller member states in particular who don't want to lose control. Put the politics aside, the notion of building a single regulator as a way to build a market simply doesn't make any sense. So while there's a lot of stuff on the good side of the ledger, we do tend to pull ourselves back to our biggest weakness in terms of regulation.
Thanks, Steve. You didn't mention among the funding security and the cross-border activities that the dollar books of the Europeans are dependent on the Federal Reserve's crisis lending to central banks and thence to the private sector financial firms. David.
Great. Well, it's a pleasure to be here, and I really appreciated Paolo's shout-outs to Nev's book on European financial market integration, my book on cross-border financial standardization of capital rules, among other things. And I want to suggest that with those two recommendations, I think your beach reading needs are sorted. And also, I think you can make some real progress on your Christmas giving with attention to those things. Okay, I want to take the perspective of like a relatively unfashionable perspective of sort of George Herbert Walker Bush on the temptingness of a standardization of regulations across the Atlantic. And I'm going to talk about 3 different projects I've been working on. And in some ways, the way I think about this is, what possible reason would there be to have different regulatory regimes between the United States and Europe? Is it that Americans have a different taste to whether a drug causes cancer or not, or that Europeans have a different perspective on cures cancer, on what pollutants cause disease, or that European values about how to resolve a failing financial institution, are they fundamentally incompatible with American values? It's not clear to me why there isn't much more harmonization and standardization of regulatory requirements across the Atlantic than we see today. Of course, there are some reasons why, and I'm not talking about different tastes for the welfare state or anything like that, but rather these questions of safety and soundness. Really, it's not obvious to me why there should be any differences between American and European approaches to regulation. Now, to be sure, one way in which the different continents might approach things differently is because of different legal rules. And I see this as a reason why the Federal Reserve Bank in the United States and the European Central Bank may take different approaches to the value of fighting climate change through financial regulation. The European Central Bank has a single mandate on inflation, but it's also being charged under its governing treaty with furthering the values of the European Union, including environmental values. And so if the EU wants to do something about climate change and thinks that regulating banks is the right way to do that, I think the ECB has the legal authority to try to implement that kind of regulation. I don't think the Federal Reserve has the legal authority to implement that kind of regulation. It's on monetary policy being charged with thinking about inflation and unemployment. It may, though this has never been clearly articulated, have a mandate to ensure the financial stabilities of banks. But I don't think anything in its governing statute suggests that it's supposed to take environmental regulation into account when it comes to how it thinks about the right way to regulate banks. And so there you go. There's one reason why we might have different regulatory regimes between the United States and Europe, because of different values in the fundamental laws of financial regulators that permit the regulators to approach regulatory tasks differently. I also want to talk about two ways in which the federal government is trying to foster harmonization, the American federal government, across the Atlantic. One inside the executive branch and one outside the executive branch, involving the federal banking agencies, including the Federal Reserve, the Office of the Comptroller of the Currency, and the FDIC. And inside the executive branch, the Obama administration in 2012 issued an executive order 13609, directing departments to think about whether they could further international regulatory cooperation when engaged in rulemakings. And so this executive order was endorsement of the value of international regulatory cooperation, I think picking up on some of the things I began my talk with. Why should rules be so different between the United States and Europe? It charged OIRA with overseeing executive branch efforts to engage in international regulatory cooperation. And it directed American agencies to identify any rules they were considering implementing with international impact on the unified agenda of federal regulation and deregulation, and to report on rules that would have a transnational impact, and to tell OIRA that they're thinking about concluding those kinds of rules. And this executive branch effort didn't only involve financial regulation, but involved some aspects of financial regulation. The Treasury Department has a view about how the United States should regulate stablecoins, and the Treasury Department is subject to this executive order. But I want to suggest to you that what this executive order represents in the 12 years since its enactment, it's still in effect, is something of a failure of presidential administration. And presidential administration is something that one justice on the Supreme Court has said is a particularly good way of making regulatory policy. That's Elena Kagan. And then the majority of justices on the Supreme Court, right, if you take their separation of powers jurisprudence seriously, it looks to me like what they're trying to do is ensure that the executive branch has an unfettered president with the ability to control what agencies do. So Obama passed this executive order saying, I want to centralize presidential administration in the White House, and I want to consider international regulatory cooperation. And what we've seen is that in the 12 years since its enactment, agencies do not cite this regulatory order. OIRA is less interested in ensuring that international regulatory cooperation exists. In related trade deals that came along with this executive order, there were regulatory coherence chapters in both the Trans-Pacific Partnership and the TTIP, which would have been with the EU. Those efforts to create standardized regulatory regimes across those jurisdictions, those efforts have failed, and neither the Trump administration nor the Biden administration has been interested in reinvigorating these trade regimes with regulatory coherence chapters. So there you go, inside the executive branch, an effort to standardize rules across the United States and its foreign counterparts, and an effort which I think has failed in a way that is different than the way that most of the justices on the Supreme Court think about executive branch regulation should be done, and how important the White House should be into making it done the way the White House prefers. Okay, what about outside of the executive branch? And here, I want to talk a little bit about the Basel Committee for Banking Supervision, which I think of as an attempt to solve a problem in international law. And the problem is that multilateral treaties are increasingly impossible to do. So what I think the Basel Committee represented is governance without international law. The idea was that in a globalized economy where regulatory power ends at a nation's borders, that if those regulators collaborate and come up with common approaches to the supervision of, in the case of Basel, banks that are doing business across borders, as every bank of any size is doing these days, that might be a way to establish global governance without engaging in the difficult prospect of concluding a multilateral treaty. And many people think, and I'm one of them, that Basel's been relatively successful at standardizing capital requirements across the world. It's gone through 3 iterations, Basel's 1, 2, and 3. And it's worth noting that this, like the WTO, is, and this is why I'm giving you the perspective of George Herbert Walker Bush, was really an American-led effort to create global governance in a style that Americans thought would be good for the American economy and for American business. And what I want to suggest is that even though Basel is being notably successful, what we've seen in the most recent efforts by the United States to adopt and implement the 3rd iteration of the Basel capital agreements regulating bank capital standards is that America is departing from this global regime. And it's departing upwards. It's making it's proposed to make requirements on American banks higher than is permitted by Basel. And I'll just give you a couple of examples. American banks wouldn't be able to use internal models of credit risk, but if they're over a size of $100 billion in assets or more. Foreign banks would be permitted to do so under the Basel rules. The American proposal to implement Basel would require investment-grade corporate exposures to only be extended to those corporations whose securities are traded on a public exchange. The United Kingdom and Europe don't require that. It's not totally clear why the United States thinks that just because you're traded on a capital market, your bond issuances are risky or not, but there's another difference. And the American proposal would increase the risk exposure to residential real estate in a way that's not required by Basel, the United Kingdom, and the United States. And so the cumulative effect of the American proposal would be a capital increase of 16% for American banks as compared to 3% for British banks and 10% for European banks. Okay, so why do I care that America is doing more? I see a stop sign. I just want to say that what we had in Basel is, I think, a deal. Regulators get safe and sound banks, and banks get a level playing field that they know they can use when they do business abroad. They'll be competing against banks that are subject to the same rules that they are. And I think that was a valuable deal, and you can understand why there was political support for that kind of a deal. And if we erase the sort of common standards that Basel represents or depart in big ways from them, then the question will be, what are we getting out of this harmonization project that's no longer about harmonization? Okay.
Thank you, David. Speaking of historical contingency, I remember well the first Basel capital rules coming out, and it was pretty clear the point of those was to control the Japanese banks in their competition. It was a kind of a joint project of the Bank of England and the Fed to control the Japanese.
That's how we got 4% too. It's the highest we could get the Japanese up to.
There we go. That's right. Okay, Catherine.
All right. So first of all, like others, I really want to thank the organizers. It's so fun to be up here with some of my favorite colleagues and really friends in the field, our august moderator. But it has also just been really fun to have so many different conversations and to realize how much the conversations we're having are all growing out of shifts that have been really significant and are permeating all of the different fields. And actually, I mean, I think it's helpful just because we are kind of the second to last panel to take a step back get back into financial regulation, but think about really what's happening in financial regulation, the failed integration, which I think is really assuming a certain baseline and realizing that baseline is no longer the accurate assumption, and it's no longer the accurate assumption for a whole variety of reasons, a lot of which have come out from the last panel, but also yesterday. I mean, I have to say, it was weird for me when I looked at the program not to see anything specifically about China, because right now, transatlantic relationships to me are all about China. But of course, it came up in so many of the different panels, and I think there was a huge number of reasons. One is that like China itself is a source of significant tension in transatlantic relations. But I think the deeper point is the evolution we've seen either in what China is choosing to do or what they were choosing to do all along, but we had blinders too, has forced us to appreciate anew the incredible interdependence that was embedded in the regime that we were shifting towards of greater harmonization, greater coordination, greater standardization, greater integration, had a huge number of risks embedded into it. If not everybody was playing by the same rules, and even if they were, there were a huge number of risks that COVID helped us to realize in terms of fragilities and exposures. And we've also seen a lot of domestic backlash across a whole variety of different political regimes as people have realized, like, wait, if we don't have local control, that's actually scary to us. So yesterday, the lunchtime discussion focused some on like globalism versus parochialism as kind of like one or the other. But I think part of it is we need to tend to both. And I think in the globalist vision, we actually failed to tend adequately to the parochial needs. And so part of the question going forward is, can we have both and so I think it's like that background that is not growing just out of finance, but where finance has been a huge part of that story in a whole variety of ways. There were references, I think appropriate references yesterday to the financial crisis. It came up in the question of whether or not that helped to cement for China that maybe like this overall experiment wasn't like the road that it wanted to be on. But I think it also made clear that China had incredible advantages in being able to provide the fiscal support that the US and the Euro couldn't fully, were not able to politically to be able to provide. And that gave them an incredible advantage in terms of growth. So suddenly that additional coordination of that more heavy-handed state and the range of mechanisms that were available, where whether it's through state-owned enterprises or enterprises that the state can, actually force to do certain things, actually allowed different levers. And I think we're still dealing with that in EVs and all these other areas. And that's creating incredible spillover effects when we're thinking about finance. Because I think part of what we also realized on multiple levels, one is capital flows can be incredibly beneficial, both to like the country from where they're flowing and to which they are flowing. But it can also be a source of incredible disruptions on both sides. I mean, that came out in the investor-state arbitration discussion a little bit. It could have come out, I think, even more than that, but in a whole variety of other ways as well. I mean, one of the stories about the crisis was just a capital glut, too much capital flowing in, distorting asset prices in ways that were really fundamental. And we also realized, going back to the questions about integration, that local knowledge really matters. So I think there was a vision for a little while that like AAA was kind of this international language and could substitute for like localized due diligence and information. And German banks and regulators, among many, learned the hard way that that was not the case. That actually there's reasons that when capital flows far away, yes, risk can be reallocated in ways that are really beautiful, but the underlying risk can also change because you're not able to do the monitoring and due diligence that is actually key to being able to understand and control those risks. So I think that the assumption that we used to have for a long time that all these things were necessarily good, that we're getting to more democratic, more capitalist, more rule-based regimes, and like we're all kind of flowing to this more integrated world, has broken apart. And that's not necessarily bad, it's not necessarily good, it's just a reality. And so where David and I might disagree a little bit. And so I think part of it is just grappling with that reality. And so one of the ways that's playing out in finance is rather than this uniform assumption of these are good and this is what we're going to get through different mechanisms in securities markets and banking and these other domains, to actually having to think in more granular ways over, well, what is it we actually are trying to get out of integration or harmonization or standardization across these different areas, and really start to have a richer conversation of both like the benefits and the drawbacks. So then, I mean, just like going through, I think like this conversation has already been incredibly helpful and illuminating. I mean, so admittedly, like I have a different take than David on kind of the core purpose of Basel. I think it was about creating a floor. It wasn't about creating uniform standards. It was Japan was like, okay, well, they're the outlier. And then after like Herstat risk and like the failure of a German bank, realizing there was significant cross-border and spillover risks, it's, well, where in the financial system do we need to have certain floors? Because what's happening over there, the fallout of what's happening over there can't stay over there. So I do think that there's still an incredibly important place for figuring out through Basel and other mechanism, where do we need floors on financial regulation? Because bad things happening in one jurisdiction are going to have spillovers to other jurisdictions. I think that remains a real challenge. I mean, it worked really well when everybody believed in technocrats and people could go off to Basel and we're going to defer to regulators. But as yesterday's Supreme Court decision and a lot of other phenomena have reminded us, we're no longer in a world where people are going to accept that kind of deference. That makes it harder to make commitments in international fora because the mechanisms which are going to come back home become a lot more difficult. And it creates just a lot more uncertainty. So I think that is a real challenge. But I think there we still need to have meaningful international coordination. The point about the Fed is key, right? I mean, one of the things we realize is we are in a dollar-based system, and let's be honest, like one of the key ways that we are protecting that dollar-based system is the Fed's willingness to provide swap line, which provides dollar-based liquidity to foreign central banks. Without that, the regime would have changed a lot longer ago. Whether those are even authorized is far from clear in the law. I think at this point we're not going back, nor should we go back. But I mean, in some ways it's similar. You were talking about like the relatively narrow scope and questions over the scope of the authority of the ECB. But I think without like whatever it takes, like you would have had a lot harder time getting over that too. So it is interesting that also it is these like, we're both like anti-technocrats right now, but the technocrats keep coming in and using authority that hasn't necessarily been clearly legally authorized as a way of like keeping these systems afloat. There's a bunch of tensions there that are making people uncomfortable, but we have not fully managed to figure out how we're going to get out. I think finance is a key area where we're seeing all that. I think actually monetary policy is a huge area where nobody's ever talked about integration around monetary policy. But you know what's disrupting right now is the Fed's remaining tight. Like Japan's still trying to get, I mean, I was just there earlier this week, so I'm particularly sensitive to it, but they're still trying to get inflation. Like what that's doing for foreign exchange, I think that's part of what's going on with Europe too, right? I mean, like they are starting to, the cuts, like England's, like UK started with cuts. And then like the United States, like many people would say should have, and they haven't yet. And I think those types of dynamics where there was never any idea that we needed to have integration are actually where we're seeing a lot of the incredible disruptions. And I don't know how we start to have those conversations, and it creates real challenges for the Fed because they are very aware of the international repercussions, and that could have spillover effects for things like security that we actually care about, for the allegiances that we were talking about yesterday, and the alliances that are so important. And yet, like, it's not within their mandate explicitly to think about any of those things, but it's hard, incredibly hard, for them to be able to ignore it. I mean, I think like when Paolo was making the point that the equivalence issues are about politics, I think it is always about politics. I mean, I think the reality is it's always been about politics, and I think that's where you started. I miss having Charlie as a colleague. We used to go out to lunch, and I miss Charlie so much. Because I think as an economic historian, he understands that it is history, and it is politics, and it is efficiency and markets, but the two are always playing off of each other, and that shapes all of it, and it has always shaped all of it. I mean, like even in the background of Basel, it was always political. Sovereign debt was always zero because every country wants their banks to buy up their debt, right? And so it was not about risk, right? It's always been this weird merging of both. And I don't have answers for any of this, but I think starting to like acknowledge that we're not just moving in this like one direction towards like greater harmonization and coordination that's going to make everybody better off. And it's not just about kind of needing to de-risk in a weird, way that the term has now been contorted, China, but like with respect to China, but instead really thinking in a more fundamental way. And Abe raised some of these questions yesterday over what is the narrative that we're going to have to get the type of coordination. And then you start to focus. I mean, think about the areas that we haven't done a good job that we need to do more. I mean, the US managed to get the EU on board with sanctions against Russia, but that was an incredibly difficult, messy process. And actually to make all those things work, if you look at things like AML, like anti-money laundering laws actually are one of the areas where you massively need coordination. And FATF is one of the weakest international organizations that we have. The United States has been championing it all along and then has been like fundamentally in breach of core principles because because we're good on bank secrecy, but we're not good at the level of kind of corporations and trusts, which allow incredible secrecy. So the long and short of it is, I think like trying to move away from this assumption of the single narrative to understanding where coordination is needed, where integration is actually helpful, where cooperation is what we need, or standardization, is just kind of the move that we are in. And I think it's going to be a long and messy process.
Thank you, Catherine. Another way of saying one of the things you and I are talking about is that the Federal Reserve is in fact the central bank to the world, at least the central bank to the dollar using world, which is the dominant currency, as we all know. I think it's important that you also pointed out that standardization of regulation assumes that the regulation has it right. But if you standardize it and it has it wrong, you're in fact increasing the risk of the whole system. And your AAA example of taking the rating agencies AAA is a very good one there. It also is a good example of one of my favorite financial laws, which is the belief that something is safe makes it more risky. And that's absolutely what happened with the AAA idea. And many other things. This is a great panel. Thank you very much. We don't have a lot of time, but I'd like to go back through the panel, give you each maybe 2 minutes maximum. Choose one thing that you might like to emphasize, either in reaction to somebody else or to clarify your own statements, and we'll just go back in the same order. So, Paulo?
Perfect. And I'm great. Like now, Paul, I'm a US. Now I put the US at. Now I'm going to put the EU one. I love the discussion. Like a lot of public choice and interest group came up in setting in the discussion on international organization. But I have I think a big question about the EU, and having been involved a bit with the Commission and the European Securities Market Authority. In some recent trend in post-trading. So a question, I think, for Nivo, for everybody. So something that I found interesting is that if we look at the composition of the financial system in the member state, it's very similar to the composition of the overall financial, like the split between banking base and capital markets base. So like a general question is is there a more cultural and traditional historical problem that continental Europe without the UK would never be able to move to a more balanced, let's say, composition of its funding sources, where a true European capital markets, integrated capital markets, can truly play a role. And the reason why I'm thinking is because after Brexit, I think Alcer mentioned this aspect, it seems that the EU is missing some mentorship in what to do, how to do markets. And the reason why I say that is recently the US moved the settlement cycle from securities from T+2 to T+1. The EU felt immediately the need of, let's do the same. And I still remember being in the room with Gary Gensler on our head, telling you should move to T+1. And so again, that president was like, okay, we need to do it because the US are telling us to do that. And so this, I think maybe a big fundamental question I'm trying, as European, putting the European hat on my head, are we gonna be able to make market, to do market? Do we know how to create market? It seems that there's this historical, traditional way of looking at finance and funding in a different way. So I don't know if there is an answer to that. It's very pessimistic, but that's, it's just a general question for everyone.
I think that's a great question. We can debate that some more at lunch, maybe, with all of us. Neve.
Yeah, what an amazing panel. Thank you so much, colleagues. I'm just scribbling madly here, trying to learn. I think maybe 2 quick comments. One is, so I really like, Catherine, Kate, and David, your point about how we think about coordination. Let's do it better. I think that must be right. Focus, get it in the right place, and so on. What I kind of worry about, and from an EU-UK perspective, I have never seen the politics so strong and seen in terms of competition. Like there's a really strong competition going on right now between the EU and the UK. They are watching each other incredibly closely. They're both in a deregulatory cycle right now, which is, I'm not making a value judgment, it's just sort of observing what's going on. So there's a kind of, I think you make a great point, Kate. I think we're relearning. I think we're relearning how to live together and yet compete, because that's a whole different dynamic, I think, for the EU and the UK. So I think you give me a lot to think about on that. I think secondly, Paolo, going to your point, it's a really great one about the EU without the UK. What's super interesting about it is, so I got this wrong, right? I predicted that once, post-Brexit, the EU would get even more dirigiste, it would get more and more regulatory. And of course, we see this now with the Euro SEC, which doesn't make sense. But anyway, that aside, there's a really striking deregulatory tilt going on right now. Utterly unexpected. You would have expected that was the UK, but that's there. Now, the UK is also deregulating, so there's a bit of a shadow going on. So that's a kind of interesting dynamic. And then secondly, going to your point, Paolo, what I think the EU always forgets, they want to be the US. They want the massive, deep retail market that the US has. And they always forget this is a completely different social model. You just need to look in one direction, and it's how we do pensions. So pensions in the EU are done through the state system pretty much. You have an entirely different system. So I think we forget the structural differences.
Good point. Thank you. David.
One of the things that my talk may have made you think is, wow, this is a weird sort of technocratic optimism in the ability of bureaucrats to regulate effectively. And I think everyone on the panel has identified reasons why that might not be so. But I'll note that this executive order encouraging American agencies to consider regulatory international impact and whether they could cooperate with their foreign counterparts. The biggest proponent of that executive order is the Chamber of Commerce, which thinks that standardized regulatory rules across borders is good for trade and good for business. So you've got the technocrats and the chamber both in the same corner about the value of standardized regulatory rules. So I think what my fellow panelists have done is identified some problems. One, everyone's talked about how is it possible to take politics out of the regulatory system? Paolo talked about punishing the United Kingdom and its equivalent determination by the EU. That wasn't something that was required by the way that the UK regulatory system looked, but rather was a sort of value that the EU was trying to pursue. And I think that is something that has to be thought about. I'm not going to suggest to you that politics isn't an important regulation, but when it comes to standardization, does this drug cure cancer? I don't know what the political valence of that question really is. Okay, secondly, what about local knowledge? Kate talked about the value of local knowledge, and it is true that standardized regulatory regimes lose that sort of local knowledge. But I want to ask to you there, can we draw an analogy in corporate law? Where Arizona companies are not like, we want an Arizona regulatory regime for our Arizona-ness. Instead, every company in the United States, with one notable recent exception, has chosen to incorporate in Delaware. They don't care about the local knowledge. What they want are standard rules administered by experts. So I take the point, but there's a little bit of a pushback. Alex says one of the things you lose with a regulatory regime is you lose experimentation, right? If everyone standardizes the same way, then you may lose some resilience. And that is definitely true, though one of the things that you could do with sort of more consistent regulatory regime is create outlets, organized outlets for that kind of experimentation, regulatory sandboxes and stuff like that. And Niamh says that there's a value to competition, and that is true. When regulators have to compete against one another for business from regulated industry, you hope that that'll create a sort of race to the top, a market for law in which the best legal system is the one that industry and investors and everybody else flocks to, it is true that is something that you do lose with regulatory cooperation. So I take that as a cost that you have to think about paying and whether it's worth it.
Thank you. I think it's well argued that one of the major international competitive advantages of the United States as one country among others has been historically its rule of law and its superior infrastructure for the protection of property and the enforcement of contracts. As a case of what you're talking about. Catherine.
Two quick comments. So, I mean, first of all, I'm not trying to argue against standardization, and I don't even think you have to go global. I mean, I think we have an incredible problem in the United States where we have so many different financial regulators are asking for similar types of information, but in ways that are slightly different, and there's incredible path contingencies. So to say that there's efficiencies from having greater standardization where there's a common value, I think is like that, I couldn't agree more, and I think that oftentimes coordination is needed to try to promote that. I just think that a lot of what's happening isn't really about that, but it's about kind of other dynamics. I love the point about deregulation and competition because I think this is the core and chronic challenge in financial regulation, right? It is in a more globalized world, there is always the ability for capital more quickly even than other types of goods to say, if you regulate me more, we're gonna go elsewhere, right? Like you see it in hearing after hearing. You have like all these things with the odds, going back to derivatives of Paolo, where like, you know, JP Morgan was there. It's like, go ahead, do this if you want, but like then we're gonna go to like London. And so you have like a massive, you know, embedded deregulation. And so it's not by chance that at the moment of competition between Europe and London, and if you talk to bankers, they're like, they feel like they're being wooed, like actively wooed by different places. They're also getting deregulatory impulses. Like the two always have gone hand in hand, and then you pay the price for it, and then you have this like ramp up. But like, I mean, I've seen like threats actually being made in some ways against some of the UK regulators for like, well, if you really regulate bank executive like compensation, like you're gonna have like a real challenge you pay. And so I think that goes back to where we do need some meaningful international cooperation to create certain types of floors in various areas and helps to promote the case for things like Basel. But again, I would view those as floors rather than necessarily as standards.
Thank you. Well, like our previous panel, we're down to about 5 minutes left, but if you have short, terse, to-the-point questions, we invite them. Go ahead, Alistair, come up to the microphone.
Thank you very much. I just wanted to ask, I guess, is it working? Oh, anyway, I'll speak up.
Talk loud.
Yeah, okay. So my question, I guess, is really directed at Neve and Paolo being on the European side. I mean, when Boris Johnson was Prime Minister, it was all about divergence. We're going to diverge, you know, in data protection, in financial services, London to become, you know, more competitive than Europe and all the rest of it.
Thank you.
That has kind of, you know, and then there was the trust disaster, and now Sunak probably won't be Prime Minister for many more days, and we are gradually seeing, you know, a stabilization of the relationship. I guess my question really is that the UK in the Council of Ministers was central to the drafting, and Neve will confirm this, and Paolo, to regulations like MiFID, AIFMD, UCITS, the whole thing. So was divergence just a political slogan, really? And actually, what is the scope for divergence between the UK and the EU? Aren't we really interested in a level playing field? And is that how you see a Starmer administration in the next few days continuing down the road?
Thanks. Alistair, you want to take that?
Yeah. Thanks so much, Alistair. I mean, I completely agree with your analysis completely. I think what I'd say is, and I guess, Kate, you would have a very similar sort of experience here. You talk to the city, they do not want divergence. The transaction costs of having our own super special idiosyncratic rule book, they don't want to know about it. They would much prefer a book that is a bit costly than a book that's changing, a rule book that's changing, definitely. And going to your point, I think my prediction is, Alistair, that the Labour administration will really tone down that rhetoric completely. It'll be all about convergence, cooperation, let's talk, definitely, backed by the regulators and backed by the city as well, I would say.
Thank you. Bonnie, you get the last question.
Okay, so two of you have mentioned Charles Calamares, and as you know, he's written recently about a concept called fiscal dominance, that the independent judgments of the Federal Reserve are soon going to be supplemented to the need to finance the growing deficit. And I'm just wondering if you might call that the elephant in the room with respect to the US bond market, which influences everybody else, is the growing insolvency of the United States. Do any of you care to comment on how that reality might amend your remarks or what you see in the future? And if not, feel free to pass. We'll go sooner to lunch.
Yeah, thanks, Bonnie. Anybody want to comment on the fiscal dominance and monetary policy? I'll just tell you, as you know, Bonnie, in the history of the Federal Reserve, It's often been the case that the Federal Reserve's marching orders, and they came from the Secretary of the Treasury or the President, were to finance whatever the government needs. This is particularly occurs during wars. During wars, all central banks become the agents of their respective finance ministries. And that's why, one of the reasons why wars are the most important financial events that there are. And we have a couple of wars going on right now, and it will undoubtedly have effects. Anybody want to add anything to that, or give a parting shot on anything else?
I'll just mildly say that I think fiscal dominance, if it happens, is, and maybe this is just repeating what Alex said, totally inconsistent with central bank independence. So
Absolutely.
if you value an independent central bank, then you have to really worry about fiscal dominance.
I don't think fiscal dominance is the only threat to the independence of the Federal Reserve. Again, like if we look historically, it is not as consistently independent as it's oftentimes made out to be ideologically. The very fact it depends on a Fed Treasury accord, like the notion that like the Fed and Treasury could enter into an agreement that creates something that's independent rather than an act of Congress in itself is kind of like something that we need to look at a little bit more closely. And I think it says something to the reality. That being said, I think there's a whole host of judicial and executive developments, not to mention what Congress might want to do, but more recently it really has been judicial and potentially if we have a change in the executive that could really change the nature of the Federal Reserve. And so I think that's something we really need to be attuned to, but it's not just because of the debt.
Polo, did you have a comment? No?
Forza Italia. He's playing in 10 minutes against Switzerland. So
Here's my last.
it's like the European spirit, sorry.
Here's my last historical contingency example. I think it's little known, speaking of the Federal Reserve and the Treasury and the Federal Reserve's independence, that under the Federal Reserve Act, as originally enacted in 1913, the chairman of the Federal Reserve Board was the Secretary of the Treasury by law. So I think
But the power was
Catherine,
in the reserve banks.
Catherine,
At that point, the power was
well,
all
it
in
was
the
a
reserve
contest. It
bank,
was
yeah.
a contest, especially in New York, and so as you said, the independence notion is a story played for its own purposes, perhaps, like many other stories. We want to thank this panel for a really interesting and lively discussion. Thank you.